Hello and welcome to a very special presentation here on MetaStock in December 2022. My name is Tyler Wood, and I'm joined here today with Alex Cole, co-founder of GoNoGo Charts. How are you doing today, Alex?
Very well, thanks. How are you?
I'm doing great. And thank you all for tuning in to watch this. If you're on YouTube, go ahead and enjoy this video. But what we want to do right now is just help you sit back, relax. You're away from the markets. Grab a pen and paper. This is an educational session. We're going to talk about some tools and process through the life cycle of a trade that should hopefully help you develop your own rules-based discipline and how you can embrace volatility. So with that, Alex, I want to turn it over to you, and let's dive right in.
Yep. So the quote we have up here, we like our quotes here at GoNoGo Charts, but this one's one of my favorites. And it's just simply, we are what we repeatedly do. So we both are firm believers in process and having a disciplined checklist that you use when investing. And it makes me think of, at the moment, my son is learning to drive. Well, not quite yet, but he did his driver's ed course in school, and he's going to be learning to drive this month when he turns 16. But if you think about what would I like him to do every single time he got in the car before he pulled off, I would want him to have a checklist. Make sure he fastens his seatbelt. Make sure he keeps his foot on the brake so he doesn't roll off. Make sure he checks his mirrors before he pulls out into the street. Make sure he signals. There's all of these things that you want him to do to be safe when starting off in a car. And the same can be said for technical analysis. We need to have a disciplined process, that same checklist that we follow, that puts us in a position where we can make an intelligent decision about the market, gives us a framework within which to make decisions. And it might be using trend lines. It might be looking at pattern analysis. It might be moving averages. Whatever it is for you, whatever your sophisticated technical process is, you want to have one that you can stick to, because we know that that removes doubt. It removes uncertainty. It allows you to act instead of leaving you paralyzed.
Absolutely. So as firm believers in technical analysis, just to keep this metaphor going for a moment, if you think about a Formula One driver, right? They don't need to understand all of the physics about an internal combustion engine. They don't have to understand fluid dynamics or any science behind how the vehicle operates. Instead, as the driver of the vehicle, they need to have their objective rules for how they are piloting the craft around the racetrack. And the same applies for technical analysis. If you want to remove subjectivity and you follow the same rules-based approach every single time, you don't actually need to have a deep dive on any one industry or any new technology in the companies that you are investing in. And that's why technical analysis can be so powerful. But we have to stick to the rules. So, Professor Cole, let's talk about what a rules-based approach to identifying market trends might look like.
Yeah, so this is an example of actually probably a decade ago now, working with somebody. We came up with a way to identify trend, and it can be different for whoever you're talking to or your clients or whoever you're working with. But you're going to start with the basics. Can you visually identify a trend? Are you seeing higher highs and higher lows? Are you seeing price move in a discernible direction? And if you are, then you probably want to automate that, because you don't want to be subjective in any way. You need to find the trend, because if you can find the trend, then you're going to hopefully remain on the right side of it and profit from that large move. So if you're trying to automate that trend identification, that visual understanding of the price moving in higher highs and higher lows, you might move to something like Donchian channels, which is a technical indicator that plots for you on the chart as price makes new highs. So it'll look back over a time period and say, is price right now the highest that it's been over this period? If so, let's move that line up. And that's what you get with that red line moving, stepping higher as price moves to the top right of the chart. And the bottom line, of course, are the lows also moving higher as price makes higher lows. Now, you can take your pick here. We've worked with so many people who have so many different sensible ways of trend identification, but you might add another indicator, something like the Bollinger Bands. We know, we'll talk about them today, obviously in great detail, but you know that Bollinger Bands can be read in multiple ways. If you've got wide bands, then you're probably looking at a mean reversion type of idea. But if those bands are narrow, that's when trend identification comes into play, because you're looking for those narrowing bands, reduced volatility. And when you see a break, then you trade in the direction of that break, betting on the fact that perhaps that is the start of a new trend. So now you've got your Bollinger Bands on there as well as your Donchian channels. So of course, you're going to have moving averages. I don't know anybody that looks at charts really that doesn't put moving averages on there, except perhaps us with GoNoGo charts.
We might
But
be the first, Alex.
moving averages are, of course, going to tell you where price is relative to an average of its historical price movement. And that's inherently bullish, right? If price is above its past history, then we're trading higher than it has in the past. So you want to know where price is relative to a moving average, and you might put volume on there as a confirmatory indicator. You want to make sure that volume is confirming what you're seeing in price. Remember, volume really is an understanding of participation, market enthusiasm. If you have very, very light volume on a new high, that might be a concern. But if you have healthy volume, then that might back up what you're seeing in price. And then you might throw an indicator on the bottom panel, something like a MACD, which is in a way a bit of a blend between trend ideas, momentum ideas, price movement. And again, if the MACD is above zero, or if the MACD crosses its signal line, that's bullish information, because prices in the short term are moving quicker than prices in the longer term in an upside direction. So if you take a pause and you breathe for a second and you look towards the left side of that chart, you start to see that all of those things are happening. We've got a new high in Donchian channels, prices above its moving average, the Bollinger Bands, the price is breaking out towards the top side of that Bollinger Bands. Volume looks okay, and the MACD and its signal line are above zero. So you're starting to line up the evidence and say, okay, at this point, I feel fairly confident recommending to a client, or even just myself making a decision on the markets. I feel fairly confident that we've made a start of a trend in a new upward direction.
Now, the challenge, even with this fairly simplistic technical checklist, using a few different tools to gain confirmation, to look at the weight of the evidence that the new trend is beginning, it can introduce subjectivity or bias. And we've actually worked with a lot of even professionals who have a much more complex process than that. And it introduces a lot of the behavioral biases that trouble investors at many market extremes, where you might see 6 of the 8 different indicators that you've got on your chart confirming, but maybe you're waiting for 2 more. And if you have a bias against or for the market at any given time, enough squiggly lines on your charts, you'll be able to convince yourself one way or the other. The other problem is that oftentimes these multiple indicators are just redundant or even contradictory, and that can cause analysis paralysis, right? How quickly can you enter a trade and make a decision when you're looking at all of that weight of the evidence and many, many indicators on your chart? So what we seek to do at GoNoGo Charts is to remove the analysis paralysis, to gain a clear picture of security trends, but to keep our focus on price. And to do that, we introduced the GoNoGo Trend Indicator, which blends actually far more indicators than what we just looked at in that simple technical process, because Alex and I are firm believers that the information from these amazing works that the men and women of Wall Street have helped create over the last 50 years, we know that that information is valuable, but we know that cluttering up our charts can cause all sorts of problems for investor behavior. So what we do in the background is handle all the complex math, use all of the tools at our disposal, the things that have been tried and true, back tested heavily. And what we get is a color-coded chart that shows us trend direction and intensity. So in an upward trending environment, we say that's a go trend. Your investment thesis is a go for launch, if you think about a NASA pass-fail testing system. And we have strong and weak form. So when it's in these blue bars or blue candles, you're in the strongest trend confirmation. And in these aqua bars, we're seeing a weaker form of the go trend. Similarly, when we're in a downward trend, a no-go trend, we see purple bars in that strong form and pink bars in the weaker form of that trend configuration. At the points of inflection or points of transition, we also see at times that all of the indicators in the background can be in their neutral position. And Alex and I are we've studied the works and the life of Jesse Livermore and find that his quote is famously helpful to all investors, that there's a time to go long, a time to go short, and a time to simply go fishing, meaning that when the market is not in a directional trend, it's very difficult for investors to find outsized gains. So that's the background of this GoNoGo trend indicator. And for everybody who is on MetaStock, the great news is you can use it for free. Alex and I are so proud of this work, and we've developed with institutional investors for well over a decade. And we wanted to share it with self-directed investors and individual traders to make use of it in your own accounts as well. So all we would ask is that you send us an email, info@GoNoGo Charts. Tell us how that's working out for you. What are you trading? What's your time period? How's that helping you make more disciplined trade decisions? And so you can load that template right on your MetaStock platform for the GoNoGo trend. Now, Alex, what are we really looking to do as investors in following trends?
Yeah. Well, we don't want to guess at them, right? We don't want to say, I think that there's going to be a trend in making cell phones smaller and smaller and smaller and smaller when when that was happening in the 90s. And now, of course, you're walking around with these giant screens. So we don't want to guess at trends. We want to participate in them. So when we've identified them, we want to participate in those trends so we can make the money on the majority of the move. And we really want to remove any kind of doubt, confusion, and uncertainty. We've all been there where, something is telling us one thing, something else is telling us something else. And it gets very difficult to be sure of any decision that you make. So we want to remain objective and stick to our checklist, stick to our rules, our discipline-based investment system. And we want to act responsibly then, of course, with as little emotion as possible.
One of my good friends from the CMT Association and a legendary technical analyst, Walter Deemer, said that when the time comes to buy, you won't want to. And what he was getting at was that investors have all sorts of behavioral biases, and entering a new trend typically means you're finishing off the end of a bear market, if you're talking about secular terms, which is very scary to be the lead investor and get into trends just as they are beginning. And so to illustrate that point, we want to take a little bit of academic research. This comes from Terence Odian and several other professors. He's a faculty at Berkeley Haas School of Business. And what he did, Odian's research and many others, they took incredibly large amounts of data and they studied retail investors over a 15-year period, 360,000 day traders. Obviously, all the data was anonymous, but they looked at those trades and they looked out over the long period to find out how frequently day traders are successful over that long haul. And so if you're watching this at home, feel free to shout out the answers, raise your hand, don't worry, we can't see you. What percentage of those 360,000 day traders do you think lost money? How difficult is it in this game of the markets? Well, the answer is E. 87% lost money over the long run, meaning less than 1/3 of 1% were actually consistently profitable year after year. All right, so that's a little frustrating. This is a difficult endeavor that we are all embarking on. But here's another question for you. Similar research in terms of the sample size. They looked at 43 million trades from a retail FX broker, Daily FX, and they were looking at 15 different currency pairs. And now the question is, what percentage of the trades were profitable? Meaning, did they have a directional bet that made sense? And we just learned that 87% of day traders could not make money over a 15-year period. So what kind of edge did they have? Well, the answer is over 50% of the trades were profitable. So it's really interesting. How does that square up, right? That the percentage of winning trades outpaced their losers. It's better than a coin flip, right? They had a strategy, they had an edge for selecting directional trades. Why do so many lose money? And the answer to that question comes down to their position sizing, how they dealt with the losing trades and how they dealt with the winning trades. And this is where it comes down to human behavior. Evolutionary psychology has taught us all of these heuristics that we have developed in the human mind over centuries that tell us that it's safer to remain with the herd. Well, behavioral psychologists call that the herding principle. As technical analysts, we call that price trends. We talk about areas of support and resistance. The psychologists talk about the anchoring bias, and on and on and on. And we encourage all of you to do your own research. Pick up some books by Daniel Kahneman. His partner Amos Tversky in the 1970s came up with the prospect theory about how human beings suffer much more in giving up a loss than we gain joy in capturing a winning trade, right? So when we think about how this plays out in our portfolios, we get to something called the expectancy formula. And I'm going to get a little mathematical on you for just a minute. If you've watched GoNoGo presentations before, some of this might be a little familiar, but I want you to raise your hand if you've ever had a trade that then became an investment, right? So you put the trade on, it's working against you. Maybe you're down 5, 10, 15%, but you have such conviction in your thesis. You know this is going to come back and work in your favor. And the more you lose on this trade, the more you just want to get back to break even. Well, that's a behavioral pitfall of not just individual investors, but also professional money managers have suffered from this. And so if there are only 4 outcomes, right? A big win, we're all looking for that. Small wins, great. We'll take those. We'll just try to get on base. Small losses, as trend followers, we want to embrace those. We want to identify our losers quickly and get out, because the 4th option, a large loss, is what can be a risk of ruin. That can destroy your portfolio. And so if we can just manage risk, manage the position size, get out of losing trades quickly, we can be profitable over time. So on this graph, what we're looking at, this efficient frontier here, this curve, are all of the trading systems that break even. And it's a combination of the percentage of winning trades and the profitability per trade. So we could literally flip a coin. It doesn't, we don't have to know anything about the securities that we pick to trade. Let's say we just buy a basket of stocks. As long as we manage the risk correctly and we sell out of any losing positions quickly, as long as our profitability ratio is 2 to 1, we maintain a break-even portfolio. And the most profitable trading systems are going to be the ones that increase the percentage of winning trades and help you gain those outsized returns when the trend is in your favor, right? So somebody like Paul Tudor Jones is happy to live right over here, being wrong 4 out of 5 times, as long as he can press his bets and get those supersized, outsized gains when the trend is working in his favor. So what we're going to talk about today is how GoNoGo charts can help you do both. Become a disciplined, systematic, rules-based investor, but also help identify winning trades. And we're going to talk a lot more about volatility here in a minute. But Alex, why is price so important? Why do we have to keep our eyes right on the price chart?
Price is never restated. It's not an estimate. It's everything that is in the price we think is going to be what affects it, right? Including human emotion and that bias that you were talking about. And so if you look at this quote, it's the dollar-weighted collective opinion of all market participants that determines whether a stock goes up or down. And that consensus is revealed by analyzing price. So everything behind that price is in the price. So if we can spot a trend in price, then that's really as good as understanding the fundamentals that are driving that price higher. And so we always want to keep price at the forefront when we're using technical analysis.
My co-host on the CMT podcast, Dave Lundgren, says the best market analyst out there is the market itself. And we know that the fundamentals matter greatly. For long-term trends, those are all driven by sound fundamentals in the underlying companies. But we care about the fundamentals. We don't care about opinions about the fundamentals. And that's where a lot of investors really get tripped up, reading analyst reports, speculating about what fundamentals might matter at any given time, when the market is telling you very clearly which fundamentals matter and when, and they do that through price. So we've talked about the colors in a go-no-go trend. Alex, let's take a look at Facebook and a traditional chart of how we could use a rules-based approach just to kind of drive that point home a little bit.
Yeah, and this is just using some different indicators, but another one that actually came out of a conversation I had with a client not too long ago. And so, you've got a lot of really good information on here. You've got from moving averages to the DMI indicator, which includes a sense of whether or not something is trending. You've got the commodity channel index on the bottom. We've got RSI on the top. It gives us a sense of that price volatility and momentum. But what we want to point out here is that panel, the second panel there, is price, but it's also got Bollinger Bands on there. It's got some moving averages. And so what you end up with, to me anyway, is a chart that becomes harder to read. So it's not jumping off the screen to me what's happening with Meta's price. And yet it should be. If you've been following Meta's price, we know that it is in a very strong, has been in a very strong downward move. But it doesn't jump off the chart because the chart is overwhelmed by these indicators and is very complicated. And if we move on to looking at a go-no-go chart, this is that same time frame. And it's so clear what the trends have been. Meta was in an uptrend through most of 2020 and 2021. And then we saw it roll over. We saw some amber bars telling us that there was uncertainty in the markets. And then the no-go finally took hold. And this is a weekly chart, so a little bit longer term, couple of years. But you can see how clear that trend has been then through the end of last year into this year. So that's the same time frame as the chart we were just looking at. And again, we're not saying we don't like technical analysis. That's got very good information on it, that previous chart. And if you can pull out that information, and if you can look at that chart and get a sense of trend from it, then more power to you. But for most of the people we work with, and for me as well, it makes it more difficult when I can't see price. And so that was really the genesis, sort of the idea for GoNoGo charts came from that. I want that technical information. I want to know what's happening in terms of trend, but I want to be able to see it.
And so as investors were coming into the end of 2021, right, very difficult to know what's going to happen on the right side of the chart, right? Let's say our data ends right here in January of 2022. The point being, with a rules-based technical analysis approach, if your indicators are telling you that the trend has come to an end, right, we've gone from go to no go, what we're talking about in terms of risk management is just exiting those long positions when the trend identification moves to a new configuration. And it avoids all of this downside mess if you simply exit on a no-go, right? And we will know as soon as possible when Facebook, when Meta comes back into a go trend. But right now, on the weekly basis, this chart is still in a strong no-go trend condition. Now, the important thing that I think jumps off to both Alex and I is that most people aren't looking strictly at weekly charts. A lot of the portfolio managers that we work with that are managing large pools of institutional capital, they have to work on a longer time frame and capture longer term moves simply because of the size of their portfolios. But for everybody who's watching this, and my guess is that you're going to be looking at shorter time frames. Well, Charles Dow taught us 130 years ago that, in fact, technical analysis can work on any time frame. And he identified that the market moves in 3 major periods. He's an accomplished nautical gentleman and related the complexity of the markets to this metaphor of the ocean. So he says the primary trend, the thing that is most consistent through time, that's based on expanding GDP and the underlying fundamentals of the companies and corporations that are driving the economy. He said that's like the tides of the ocean, right? It doesn't really matter what any one newscaster or analyst or anybody says about that. That's the underlying secular trend of the market. So it's important, no matter what your time frame is, to step out and see what the underlying bias is. And if you're a short intraday trader, maybe even the daily period is your primary trend, but to keep in mind what the underlying bias of the market is will help you in these secondary and tertiary timeframes to understand the mean reversion back to that primary trend. So this secondary period, Charles Dow talked about the waves of the ocean, and you get extremes above and below that primary trend that are driven more by human emotion and by reactions to the fundamentals as they're being reported. And then that minor period, the tertiary move, the day-to-day fluctuations in price, largely driven by sentiment and what he referred to as the ripples on the surface of the water. So with GoNoGo charts, no matter what your time frame is, the charts are going to work in exactly the same way. So we talked about the S&P 500. Let's go through this in a few different time frames, Alex.
Yeah, so this is the weekly. Of course, depending on your risk horizon, the type of trader you are, these timeframes might be different. We do a lot of work with institutional money managers, and they will look at a longer time frame for at least for their market bias. You want to get a sense of the larger time frame to sort of really see what's going on from that larger picture. And on a weekly chart, you can see that really since the beginning of the year, we've been in a no-go trend, making lower lows and lower highs. Now, there's been a strong rally over the last several weeks that's put us into weaker pink no-go bars. So the no-go trend has definitely weakened. We've seen consecutive pink bars rather than those strong purple bars. And we're testing, you can imagine on there, right? Because there's nothing else on the chart, you can imagine that downward sloping trend line that is really being tested on this bar. So we'll see what happens this week. But right now we are in a weak no-go on the weekly chart of the S&P.
And so with a lot of investors, these relief rallies have been pretty short, but very seductive. And we certainly don't, we're not trying to tell anybody how to trade or what time frame you want to be in. But in that longer term perspective, we're still in just a relief rally until proven otherwise on this weekly time frame. So let's dive down, Alex, into that daily time frame, also for the
Yep.
S&P 500.
So again, S&P 500, this now using daily bars, you can see that we are in a strong go. So when you jump down the time frame, we are seeing a series of higher highs and higher lows, and we are now in a strong trend. We've seen a real string of uninterrupted bright blue go bars there that are telling us that that's the case. So counter to what we're seeing on the weekly chart, but remember the weekly chart is weakening to those pink no-go bars. So we're at that highest point of that weekly relief rally, if it is a relief rally, or if the weekly chart turns to amber, or we see some sort of confirmation from there that this daily chart might have led us into something more constructive. So strong go trend on the daily chart.
So if we know that the longest term, right, the weekly perspective, we're just in a relief rally, but we can see that it has strengthened to a go trend on the daily, or perhaps you're biased to the upside and you want to capture some of that upside volatility, you could drill down even further into an intraday chart, taking a look at maybe 2-hour bars, where you could get sizable and optimized entries into that upward relief rally. Alex, anything you want to point out here on the shorter term chart?
Yeah, just as you said, if you're somebody that's trying to make gains in that relief rally, or even fading the long term, the relief rally that we see on that long term chart going to pink bars, then you might be looking to take go signals from a shorter time frame chart. And over the last several weeks, with the daily chart in a go trend, there are opportunities here to get entries using a smaller chart here. And you can see right now we are in a strong go still on the 2-hour chart.
Absolutely. Now, we often talk to folks who are not equity investors, commercial hedgers, people who work in commodities and futures markets. And so, building off of the work of the great John Murphy, a CMT charter holder, as well as authors like Marcos Katsanos, who helped categorize and quantify what those intermarket relationships are. Alex and I have learned from the best on how to develop a top-down approach to technical analysis. And I want to encourage all of you. Perhaps you are an equity-only investor, but in your analysis, you have to take a look at all of the other asset classes and look a little more broadly to understand how those macro forces might influence the equity markets that you're trading in. So, Alex, let's do a quick round robin of all asset classes using just the GoNoGo trend.
And us, we love to do this. I think if you can get a sense of what's happening around the world and from these major asset classes, it can really help you understand the narrative. And so right away, you can put a chart together. You can put a multi-layout chart together and get a quick sense, just like we're going to do now. U.S. equities, strong go. We saw that. These are all daily charts, of course. So U.S. equities are in a strong go. Treasury bond prices. Remember, prices move inverse to yields. So we're talking about bond prices now entering a strong go as well. If we move over to oil, you can see that oil has really struggled to have any kind of consistent direction since the summer. It was the trade of the year up until then, and now we've corrected heavily, and we've tried a few times to get back out to the go trend, and it hasn't really happened. So we're in a weak no-go on oil. Bitcoin hasn't done much for anybody this year. We're in a strong no-go on Bitcoin. Gold now, finally, gold joining the race to move higher, painting strong go bars. Gold's been an interesting story, of course, not performing well, even though some thought it might be a flight to safety in the rising rate environment. And then on the last chart here, look at that rollover and that collapse of the US dollar. People were calling for it all year. Didn't happen until really the beginning of November. And now we're in a no-go, painting strong no-go bars on the dollar.
And so the reason that we look across the asset classes is to understand what are headwinds or tailwinds for risk assets or for equities. right? And what has been happening in the U.S. Treasury market, and with rates rising to historic record levels off of those COVID lows in 2020, has really been an affront to a lot of the growth narrative. A lot of the tech firms and long duration equities, is what we call them, have really struggled this year. We've seen a rotation back to value and cyclical sectors. Same thing with the U.S. dollar, right? Strength in the U.S. dollar has been a real challenge to a lot of risk assets, and certainly emerging markets. Anybody who's investing globally, this recent weakness in the U.S. dollar has been a great opportunity to look for opportunities outside of the U.S. Now, for anybody who is interested, we started this company with our institutional subscribers, and we do research notes every week, Monday morning, top-down approach called Flight Path, that goes through all of the asset classes and then drills down into the sector groups of the equity markets and into individual names for those that are showing the strongest relative performance. We also send out every Saturday morning, again, believing in a disciplined approach to technical analysis. You need to step back and step away from the trading desk and get a sense of what's happening longer term and across all of the asset classes. Launch Conditions goes out every Saturday. So you can find out more information about that at GoNoGoCharts.com for those of you who are interested. But we're going to pull a few ideas here in the second half of this presentation directly from research. We talked a little bit about the US dollar and that very surprising trade. We work with a lot of analysts and really expert folks in the field who were calling for a top in the dollar all the way up. And it was really, really damning evidence to everybody that that trend just kept rising through the summer and into the fall. And so we just try to be responsible reactors, right? Market observers, rather than trying to postulate or guess at what is supposed to be happening. Now, congratulations, everybody. You have made it to the 50-yard line. We're through the first half of today's presentation. If you're interested in getting a copy of the slides, feel free to shoot us an email, info@GoNoGoCharts.com. Just put MetaStock in the subject line. We'll make sure to get these right over to you. But as the title of today's presentation indicated, what we really want to focus on is the idea of a volatility squeeze and how we can work through the life cycle of a trade. And to do that, we're going to use the complete suite of GoNoGo charts that's available for purchase in MetaStock. For those of you who don't have GoNoGo charts on your MetaStock account yet, you can head right over to metastock.com/GoNoGoA. And that'll give you complete information about that complete suite of tools. But Alex, let's keep rolling here, and we'll talk about the complete GoNoGo solution available in MetaStock. Now, for everybody who's been listening, we have covered the idea of blending technical indicators, a price trend indicator that's taking a look at the weight of the evidence, coloring that price action according to the strength and direction of the trend, but keeping our focus just on price action. After all, it's only price that pays. And here in the second half of today's presentation, we're going to focus on this bottom panel, a blend of not just momentum indicators, but also volume and volatility, which is going to be a core focus for us in the second half of this presentation. And so, Alex, let's talk a little bit first about momentum and the idea of blending multiple momentum studies into the GoNoGo Oscillator.
The same thing is true when you're looking at momentum studies. You want all of the information that you know has value. So over my it's crazy, but 15 plus years now in the industry, there are certain things that I want on my chart, right? There are certain things I need to know to make a decision. There are certain things I want to know before I talk to a client. And momentum studies have all kinds of value. You can get a sense of the strength of any kind of price movement, but we can clutter our chart with multiple indicators. We add those indicators to the chart that we looked at before, where we had a trend identification chart. And all of a sudden, you can see how you're really starting to complicate the chart by adding even more now. Forget just trend identification, but now we want to know about momentum. And then later we're going to talk about volume, and then we're going to add volatility. And all of a sudden, you've got a chart that you can't read. But we do want that information. So what we did was take the same concept that we were talking about with GoNoGo Trend and blend the primary concepts, the foundational concepts of momentum, into one oscillator that would give me all of the information that I needed without having to have more than one panel on the chart. So the goal of GoNoGo charts is to have all of the technical analysis pertinent to decision making in one chart that has a large price panel and one panel down below. Now, with the GoNoGo oscillator, you can still use it in the traditional sense. You can easily identify areas of overbought and oversold. When you see the oscillator making a high or a low, those are going to line up with the peaks and troughs of price, because we are identifying quick movements in a direction that are perhaps too fast. You can also identify divergence easily. Divergence is a very important concept in technical analysis. And so momentum divergence, when price makes a higher high, but the oscillator doesn't, that gives you some real information. This enthusiasm on that second high in price is not the same as it was the first time. So that's some really important information. And of course, we also want to incorporate volume. Now, in different implementations, we incorporate volume in different ways. But here on MetaStock, you can see how we have a dark blue ribbon telling us that that volume is heavier than usual when it's that dark blue. So if you see a strong move in price, dark blue, either on the oscillator or in that ribbon, you know that you've got the market confirming, participating in that price movement.
Now, what's really unique about the GoNoGo oscillator is the idea of neutrality, right? So we talked about before in this price panel, blending multiple technical indicators. And at times when all those indicators are in their neutral fittings, we have a neutral trend or a go fish bar on the price panel. Same thing exists in momentum oscillators, but when we are using a tool that was originally developed for mean reversion strategies in the US markets of the 1970s, we have to understand that using momentum oscillators while in trend is going to be a bit different, right? When it repeatedly hits these overbought extremes, that doesn't mean a reversion or the end of a trend. What we're looking for instead is this continual retest of a neutral zero line. So the way Ralph Akampora explained momentum to me over a decade ago when I first joined the CMT Association was that he said, Tyler, picture a baseball in your hand, right? And Ralph's from the Bronx. Everything's baseball with these guys. He said, the moment that you throw the ball in the air, the moment it leaves your hand or your glove, that's going to be the fastest that is moving. That's the highest momentum, a momentum surge. And then it's going to reach the apex and it's going to slow down, decelerating, and then it's going to come back down to your glove. Okay, that makes sense. As long as you catch it in your glove, you throw it again, right? The game of catch continues. Momentum can surge higher, slow down, and come back to your glove, to that neutral level. So with GoNoGo Oscillator, instead of having this subjective, well, what actually means neutral in an RSI or any other momentum oscillator, we've got an objective zero line that's going to show us areas of support when we are in a go trend, right? Momentum is positive. It comes back down to test zero and then surges back into positive, even overbought territory. And that's going to tell us that the life of the trend is still healthy, right? This is the buy the dip moment that we all heard about from TikTok traders in 2020 and 2021. Oh, don't worry about it. Anytime the index corrects, that's just another buying opportunity. Things are on sale and it's just going to continue to go higher. But we all know that that's not how markets work. But to be objective, rules-based traders and investors, we have to find a way to use our tools in an objective sense. So this zero line in the GoNoGo oscillator provides that for us. It gives us that signal of support. And I want to mention for everybody who trades to the short side, if you're into derivatives and you're looking to capture those downside moves with a short position, you can use all of these tools in the exact same way in reverse. And we're going to show you a few examples about that in just a minute. But the idea of trend and momentum playing together with this objective neutral line is really important. I want you to all hold on to that here through the rest of the presentation. Alex, let's talk a little bit about the icons that accompany the GoNoGo suite of tools.
Absolutely. We put two icons on the chart. They're a little small on this chart, but we can see them nonetheless. The first type are trend continuation icons. Now, these icons highlight the return of momentum in the direction of the trend. That's that situation Tyler was just walking us through, where the oscillator finds support at the zero line. He didn't drop the ball and he threw it back up in the air again. So that's those situations where we are seeing trend continuation. The second type of icon are counter trend correction arrows. Now, those are using the oscillator in the traditional sense. Let's highlight those areas of overbought and oversold extremes because that is very useful information. So those are the two icons that we put on the chart for you, because the power of data visualization is so important that we want this information, but we want to keep our eyes focused on the chart. So how can we do it? How can we highlight the interplay between the oscillator and the trend in a way that keeps us focused on price movement?
Absolutely. And now, Alex, for the main event, right? So we're going to get back to a GoNoGo chart here really soon. But first, we want to talk to you guys about volatility. And I think for a lot of investors here in 2022, it's been a challenging market, and volatility has been something that we're afraid of. And today, we're talking about embracing volatility. And we can use volatility compression to help us identify areas of trend continuation and trend reversal. So what we mean about what we are defining as volatility compression is often happening at inflection points where there's a tug of war between buyers and sellers. And we know that from periods of low volatility, we'll see periods of higher volatility. Volatility in one direction or another. We'll see price movements that can be very swift and volatile. And that can happen at either a trend continuation or a reversal. But how do we identify these areas without subjectivity? So, Alex, talk us through some of the traditional methods for looking at volatility squeezes.
Yeah, again, powerful concepts that you've got to be looking at. You've got to have these on your charts. What we want to do is identify areas of reduced volatility. A lot of people talk to us about volatility and they sort of, how do you trade in these volatile markets, or how do you stay away from volatility? Well, that's not what we're trying to do as technicians. We're trying to find situations where we may be on the right side of a high volatility move, right? So what we are looking for are those beginnings of trend. We're trend followers at our core, and most technicians are. And you want to identify areas of reduced volatility, because those often lead to areas of increased volatility. And there are several indicators that capture this kind of idea. You've probably heard of Bollinger Bands, Keltner Bands, you name it. But the general idea is that you're looking for a narrowing of the bands, because that shows you reduced volatility. So let's quickly go through a couple of examples. This is using Bollinger Bands on the security INSW. Now, at several points in this chart, the bands look like they're narrowing. Now, the problem is that just like all the other problems we have with technicals, is that we end up being subjective. How narrow is narrow? And Bollinger, brilliant as he was, incorporates this in that lower panel, which is band width. Now, on that bottom panel, we can see the relative width of the band. So we can look at when that line on the bottom is making a low, we're seeing a low for band width. So towards right where your marker was there, Tyler, that's another low in bandwidth. That's telling me that the bands are narrow. So I'm looking at that and I'm thinking, okay, the bands are narrow here. How narrow is that? It looks like it's just about as narrow as it was a couple of other times on the chart. And so right in there, somewhere on that right side where the bands get narrow, I'm going to be paying attention to Bollinger Bands to see in which direction the bands are broken. If price trades outside of the bands, then we trade in the direction of the break. Let's do another one. If we move forward to another example, this is using UUP, which is the ETF, of course, for the dollar. Now, this one's a little bit more difficult to sort of identify an obvious low in that bandwidth. Like, where is the bandwidth really low compared to its history? Now, there's a few areas on the chart, but how could we have used this Bollinger Squeeze idea to identify this recent rollover in the dollar? That's really what we're trying to do. So is that on the right side of the chart there, is that low enough? If you go one more, I don't know if you're looking at that bandwidth, if you'd think that was an extreme low in bandwidth. But we know, of course, that the price did roll over out of that break of the Bollinger Band. So it's very, very helpful information. We know how important the statistical, the meaning behind Bollinger Bands is. If price is outside of those bands, very important information, of course. And we want to trade in the direction of the break, especially when the bands are narrow. So you get subjective a little bit in trying to decide whether the bands are narrow enough. And now comes the real problem when we add the process of finding Bollinger Band squeezes, or whichever squeeze you're using, to our already problem chart, right? We've already got our system on here. We've already got our technical checklist. We add Bollinger Bands to it, and now it's even more busy. We've got momentum concepts on here. We've got trend concepts on here. And like, if you just look at this chart, even if you zoom out, Tyler, like, can you see where that band narrowing happened? And is it easy to identify that situation where you're looking for a reduced period of volatility, as well as understand what else is going on with price? Now we have a bigger problem.
Now, this is the nature of using the go-no-go squeeze, right? The nature of all technical analysis is that it's an evolving discipline. The greats like John Bollinger and John Murphy and Ralph Acampora built upon the works of people before them. And so too has go-no-go charts. So the idea of volatility compression is age old, and it's been incredibly powerful for a lot of traders and investors. What we want to do is find a way to use these tools, but use them in their most objective way to avoid any analysis paralysis and give ourselves a very clear picture of what's happening on the chart. So again, we're talking about volatility compression, and if you just stick with us through the reading this chart, right, from left to right, we're in a no-go trend. We see the price range, right, the range of trading action is narrowing. We're seeing a negative momentum in the GoNoGo oscillator come up to this zero line. And instead of just testing and being rejected back into negative territory, it persists at zero. And every bar that the GoNoGo oscillator remains at the zero level, right, in neutral territory, not positive or negative momentum. We're seeing that tug of war between buyers and sellers. That's going to build this grid of the GoNoGo squeeze. So we reach a max squeeze, and it's prolonged for several periods, several more bars or candles, whatever you're looking at, until we see a break. Now, in this circumstance, right, volatility compression doesn't mean that there's a lack of trading, right? We're seeing heavy volume, as shown by this blue ribbon in MetaStock, during a go-no-go squeeze. And it's that volatility, that tug of war between buyers and sellers, that then gives us the signal break. We break out of the go-no-go squeeze, not back into negative territory for a trend continuation, but instead we see momentum turn positive. And that's a leading indicator of what is to come in price. A break to the upside of a max squeeze when the momentum was in negative territory is a leading indicator of a price trend change to come. And so now we maintain positive momentum. We come back to test the zero line, and the new trend has taken shape. But what we really want to focus on are these areas of the max squeeze and using that break to tell us what direction the volatility will ensue. From this volatility compression, from that narrowing, tightening price range of trading, we see a very swift, high velocity move in the direction of the break. Same way that we would use a Bollinger Band or a Keltner Band to trade in the direction of the break. So Alex, let's go back to international seaways and look at the example, not with that ultra complex chart, but with a go-no-go chart instead.
Absolutely. So in the middle here, you can see that squeeze build, that climbing grid gets to its max. That's the same area where we noted that new low in Bollinger Bandwidth. That's that same area where we saw, okay, the Bollinger Bands have really narrowed here when we were looking at the Bollinger Band in isolation. Remember, when you look at the complicated chart, very, very difficult to see. But when that squeeze was broken into positive territory in the same direction as the go trend, we can say, okay, trend continuation. We had a reduced period of volatility. We've broken out of the squeeze into positive territory, and we expect new highs. And that's what we've got. And then the next example, I think, was the dollar again. And you can see now that rollover in the dollar is easier to identify and clearer. We were sort of a bit more hesitant to say that's a really narrow Bollinger Band, that's a real volatility squeeze, because it wasn't as obvious on that chart. And now we're looking at this squeeze, multiple squeezes here actually, as price topped out. We see the squeeze try to get to a max, but then the oscillator get back to zero, and then the squeeze rebuild to its max and get broken, then this time into negative territory. You combine that with the fact that you saw an amber go fish bar, uncertainty, and then we retest that zero line relatively quickly. We roll over again, the no goes in place. And so that sort of tells us, okay, out of this compression of volatility, we have a no-go trend. Now, this is a reversal taking place really out of the squeeze.
Absolutely. So let's go back to our ultra complex chart, right? Which really isn't, there's nothing unwarranted that's on this chart, right? This is a disciplined technical analysis process using multiple indicators to give ourselves the weight of the evidence. But unfortunately, it becomes very difficult to read. And if your charts look like this, that means that you've been studying technical analysis for a while. You've found indicators that work for you. You're looking at very important information. But perhaps your trading account is struggling because of the emotional or the behavioral biases that come into play when you have too much going on your chart. So coming back to that US dollar chart, right? We see the trend change out of this go-no-go squeeze, the break to the downside, and then momentum cannot get back to positive territory. Volume picks up to the downside as the trend changes to a no-go. Now, let's go through a couple of other examples. Alex, I loved talking about Netflix all year long. So many sell-side fundamental analysts continuing with their buy recommendations all the way down. I think it was 37% off of its high when it gapped lower. They all finally capitulated. But let's just go through this go-no-go chart, Alex, and talk through the multiple squeezes that we can see here.
Yeah, this has been a very interesting chart for us from a go-no-go perspective. That fade these gaps, fade the move lower. We heard it all the way through this downtrend. The no-go persisted for a long time, and all the way through that, we see these go-no-go squeezes build up. The first one there on the left, we saw a squeeze build, was broken to the downside. No-go trend continuation. We see a second squeeze build as price stabilizes, volatility is reduced, but then that max no-go squeeze is broken to the downside, trend continuation again. Later on in the chart, when we see that max squeeze, this time we're looking at it and thinking, okay, if this breaks down again to the negative territory, that might be trend continuation, but this time it didn't. It was broken out into positive territory, which suggested that at least for the short term, the no-go trend would be in trouble. And indeed, we then got some amber bars and then, of course, some go colors as Netflix prices got off the floor. But that squeeze could have been used throughout that no-go to add to positions. And then it could have been used as an early warning that perhaps the no-go trend had come to an end.
So if we think about the life cycle of a trade, if you're trading to the short side and you've got some options on Netflix, right? You're leaning into those when you see the go-no-go squeeze break back again to the downside. That's a trend continuation. We've got the red circle, a trend continuation icon on price. You lean into those short positions, you capture all of that move and the gap down lower. We get back into a squeeze. Maybe you're covering your short position here until it breaks again to the downside, and you've got trend continuation icons repeatedly. Here, it's actually moved into positive momentum. We even saw some amber neutral bars there. Maybe you close out those short positions only to get back into the short trade when you see the next trend continuation, carrying it all the way down. And the point that we were trying to make in today's presentation is that volatility compression can happen in two places. It can happen in trend continuation, right? If bulls and bears are fighting for control, the bears have taken over again and again. Each of those max squeezes leans back in. And what we know from that herding behavior is that all traders and investors, right? It gets to that point of real volatility compression, a real tug of war. We all pile into the trade when there's a clear direction again. And the second way that a go-no-go squeeze can really help you is at the points of reversal, right? We see this inflection point. We've had a real bottoming process. Alex and I have studied the works of Edwards and McGee, and we love some of the traditional price pattern analysis. You're going to see that on go-no-go charts much more easily because the price panel is uncluttered. So you can find those pennants and flags and look for areas of trend continuation using the go-no-go squeeze to trade in the direction of a break at either a trend continuation or a trend reversal. So with all of that, here in the final minutes of tonight's presentation, we just want to share with you how simple it can be to trade using go-no-go charts. Because there are only 3 questions you have to answer on any chart, any security, any time frame. And that is, what's the trend? Where is the go-no-go oscillator at, right? Are we seeing positive or negative momentum, confirming or diverging from what we're seeing in price? And then is there anything important happening at the zero line? Are we building a squeeze? We need to pay attention to a volatility compression. All right. So let's dive in. We're going to pull some examples from premium research that goes out daily to our institutional subscribers. You can check out more about that at GoNoGoCharts.com. But some of these ideas involve looking for those max squeeze conditions. And so we're giving our subscribers a little heads up about securities that we've found in our own scanning and research. So Alex, let's take a look at what happened to Spirit Airways, SAVE.
Yep. So that one went out because we saw that max squeeze build in the middle of the chart, and we were in a no-go trend. And the message was, we're in a max go-no-go squeeze, right? Volatility, compression. We're going to look at in which direction that squeeze is broken. Now, given it's a no-go, we are waiting to see if it will break in the direction of that no-go into negative territory. And in this case, it did. And so then we got a continued move lower, multiple lower lows and lower highs on save. Now, where are we now? Now we are in a go trend. We see strong go colors. The oscillator is at zero, testing the zero line, and we're going to ask whether or not it can find support now at that zero line, as we know that it should, if this go trend, the new go trend, is to be healthy.
Absolutely. Let's do another one. TIXT, which is a technology company. This idea also came out in September. A GoNoGo Squeeze at a reversal point.
Yep, slightly different one. This one, instead of it being a continuation, we saw a squeeze happening as price was struggling to make new highs. We see that max squeeze in the middle of the chart. We see it roll over into negative territory on heavy volume, and we see the no-go really take hold. And of course, you can see what's happened since. Now, interesting moment. What's happening with the trend? We are in a no-go trend, but it's weaker, actually. That's a misprint there. Apologize for that. Where's the oscillator? The oscillator is now in positive territory. So we know, look at the image here. We know that should have found resistance there at that zero line. It shouldn't have been broken into positive territory if this no-go was healthy. So this is the first sign that the no-go trend here in TIXT might be coming to an end. And then I think we have a couple of live squeezes to finish with, or at least one.
Absolutely. And just before we get to that, the implementation in MetaStock is truly unique. And for those of you who are MetaStock users, you're going to find that GoNoGo Charts is incredibly easy to use, in part because it's like having Alex and I over your shoulder every chart that you pull up and looking at every bar with something called expert commentary. And that is the ability to just get an explanation of exactly what's happening on the chart on any given bar, right? So the interpretation of the trend, what's happening with the oscillator, what's happening with the GoNoGo Squeeze, how you can use that to your own advantage. And Alex, the other most powerful part of the MetaStock implementation, talk to us a little bit about explorations.
Absolutely. So we all know that we're busy. We have a million things to do. There are thousands of securities we could be looking at for opportunities to trade. And so screening, and in MetaStock, of course, those are the explorations, is incredibly powerful. And right in MetaStock, you can search for max squeezes. You can search for the icons, trend continuations or counter trend corrections. And you can search for new goes and new no-goes. All of the go, no-go criteria that we look for on a daily basis, you can screen within MetaStock for that. So, of course, screening, incredibly powerful, great implementation in MetaStock. And, it really does save us all kinds of time.
Yeah, thank you to Jeff Gibby, to Kelly, and to the whole team over there for just putting together an incredible implementation of these charts. Let's go through a couple more. Yep. AAP, we've got the trend in a week go. We've got a negative oscillator at -2, and it broke out of that max squeeze to the downside just ahead of this gap down and the trend change. So using those volatility compression moments can be really helpful to investors to find those opportunities to spot trend reversals or trend continuations. Right. And again, just to point out, for those of you who would like to use GoNoGo charts on MetaStock, you can head over to metastock.com/GoNoGoA and get all the information you need and apply these studies to your charts right away. Let's do another one, Alex. We've got a squeeze continuation this time. We're looking at our favorite, Cisco, toilet paper company.
Utilities company. We see a max squeeze that's built. This one I put in here just because, interestingly, we broke out of that squeeze. We got trend continuation. We saw price move higher to test those prior highs. And now we're back at zero on a slightly higher low. So we've got some movement higher in the price chart, and we're back at zero on the oscillator. So we're testing the zero line from above. If we see support here, then we can expect price to make an attempt at a higher high.
Absolutely. Absolutely. Alex, right now we're looking at Amazon. We're at an inflection point. Talk to us a little bit about this chart.
Yeah, the Amazon one is, of course, interesting. We've been in a strong no-go trend for a while, but look at the length of that squeeze. We've got an extended go-no-go squeeze happening now, as it looks like price has made a higher low. Perhaps this is a basing. It looks to be, we don't like to predict We like to react responsibly, but we are making a higher low from that low at the end of November, middle of November. So what's going to happen with this squeeze? We're in a max squeeze, extended period of reduced volatility. We'll be looking to see if this gets broken back into negative territory, which would indicate that there'd be continuation of the no-go trend. But if it breaks into positive territory out of this max go-no-go squeeze, then definitely a threat to the no-go. We might look for trend color change in the price panel above.
Absolutely. Personal anecdotes aside, for all of you who have been shopping Christmas presents and getting those delivered from Amazon, certainly would be a season to see that squeeze break. But we'll be watching closely and reacting responsibly. Thank you all so much for joining us this evening to talk through GoNoGo charts. And if you're watching this on YouTube, thank you so much. Like and subscribe to the MetaStock channel, but you can also check out GoNoGo charts on YouTube. And we'll look forward to seeing you again in the new year. Be well. Thank you so much. And we'll talk again soon. Bye-bye.